Hello and welcome to the Action Podcast, where I, Asner Midov, interview accomplished investors, entrepreneurs, business and thought leaders about their personal and professional journeys. In this episode, I sit down with a famous value investor, Vitaliy Katsenelson, who is the CEO and Chief Investment Officer of Investment Management Associates. Vitaliy has written several books on investing and is a frequent speaker at the industry events. We spoke about value investing, his stock picking process, his biggest mistakes, his bucket list, and many other things. I'll let you listen for yourself. Vitaliy, thanks very much for being on the podcast.
It's my pleasure.
Let's start with a quick introduction of Vitaliy Katsenelson.
I came from Russia in 1991. I was 18 years old, and I basically spent my whole adult American life in Denver. I graduated from University of Colorado at Denver, got my undergraduate degree in finance and then a graduate degree in finance, and then I got my CFA. And I've been basically investing since 1997. I've been with AMA from 1997. And the way I look myself is kind of a die-hard value investor. And I'm also the guy who thinks through writing. That's why you get to see some of my stuff in the internet, because that's how I think. Some people think you can think very well by talking to others. And I do that somewhat, but most of the time, I get most of my ideas, my best thoughts when I'm sitting in the early morning in a dark room with my headphones on and just basically just stare at the screen and listen to music and write.
And you invest on behalf of Investment Management Associates, right?
Yeah, so I'm a partner at AMA and I have a partner, Mike. IMA's clients are basically high net worth individuals who want to grow their wealth but don't want to worry about the markets. So these are our clients.
And what's your role at IMA?
I'm a CIO and CEO and a portfolio manager.
So you run the company, let's just say that.
Yes, with help of very capable other people here, but I try.
Vitaliy, you mentioned that you are a value investor. Can you define value investing for people who are not familiar with the term?
So value investing is one of those very confusing terms, because when I say value investing, when I'm a value investor, the first, if you had to describe it with one word, what do you think it would be?
Okay.
Cheap, right? Yeah. So it's cheap. Well, to me, that's an incredible oversimplification of what value investing is. To me, value investing is basically philosophy. And it's a philosophy because it's a way of thinking about investing. It's more than just buying cheap stocks. It's really the way of thinking about investing in general. And at the core of that philosophy, basically what I call the Six Commandments, that Ben Graham described in his book, The Intelligent Investor, which is basically, if I remember all of them, but the number one would be you look at stocks not as pieces of paper but as businesses. The stock market is there to serve you, not the other way around. True risk is not volatility, but permanent loss of capital. And the list goes on. So, and by the way, let me do an infomercial. I have a kind of a podcast, which is, where the very, very first episode of the podcast is basically takes you through all the 6 commandments about investing. So if you go to investor.fm and listen to it, there's a 25-minute podcast, which is the excerpt from my next book, hopefully, when I finish it, and it walks you through that.
So how is it different from other types of investing?
Warren Buffett says that basically the word value investing is a little bit redundant, because it should be just investing, because it's a commonsensical way to invest. Everything else is basically kind of different shades of it. Nobody goes into stock market say, I want to buy companies that are overvalued and I want to look for another fool to buy it at a higher price. That's basically looking at the stock market as a casino at your fingertip. It's really looking at treating stocks as gambling. People do that, but it's really not investing. It's something else. When you do this, you're trying to find some kind of order in a very random environment. And so some people do that, and that's fine, but that's not investing. Just let's be clear about that. That is more systematized version of gambling, or
How did you discover value investing, and why did it click? Because I don't think they teach it in CFA.
I came to value investing not right away. In fact, so when I joined IMA was a kind of growth at reasonable price. It was started by Mike Kahn, who is my partner now. And Mike has done a phenomenal job running the firm, had a phenomenal track record, but it was a growth at reasonable price. And what I realized, and that strategy has worked well for a long time, except after the dot-com bubble blew up, we actually, as a firm, have done very well because we were not playing the dot-com bubble game. But year after that, we started to struggle. We had a few years which were kind of difficult. And I was trying to figure out why. And what I realized that we owned kind of high-quality companies that were real businesses. But what happened to them was they basically were fully valued when we owned them. This is when I realized when you own stocks, you really want to have margin of safety. And this realization that you need to have margin of safety, that turned me into value investor.
How is it different from GARP? Because if you look at Buffett, somebody would argue that he actually uses growth at a reasonable price. Would you agree with that?
Okay, this is where it gets more complicated because I think there is a value in growth. And so when Warren Buffett was buying Coke, for instance, in the 80s, it may not have passed Ben Graham's screens of cheap stock. It was because it was not statistically cheap. But what Buffett saw at the time is that the Coke had a huge growth runway ahead of it. And therefore, if you looked at Coke from perspective of earnings 5 years out or 10 years out, actually it was an inexpensive stock. So the difference between value investing and GARP, I guess what you put your emphasis on. And I'm not going to profess that I'm a huge expert on GARP investing. Like today, I don't even distinguish difference between GARP and growth because I do own companies today that are what's considered to be GARP companies. Except if I look at earnings, 5 years out, then this companies actually look significantly undervalued. So I'm almost like everything we do, we try to kill the business and we look for margin of safety first. We ask ourselves a question: is it a high quality business? If the answer is yes, then we ask ourselves, do we understand the business? If the answer is yes, then we say, well, what is it worth? And then we look at the price to what it's worth, and then that drives our decision.
What's your take on diversification versus concentration?
I look at it from the two extremes. Okay, so on one side, when you are over diversified, when you have hundreds and hundreds of stocks in your portfolio, let's say you have 200 stocks, so average position is going to be 50 basis points. So if you've done this incredible research, the company in your portfolio doubles, so your portfolio goes up by 50 basis points. So it's a lot of work for very little. So that's the problem. Is kind of over diversification on one side. Also, another problem is it's incredibly difficult to do thorough research on the portfolio of 200 stocks. So that's another problem with that. Then let's take it to another extreme when you say you have a portfolio of 2 stocks. And you're probably going to know a lot more about these 2 stocks than the portfolio manager on another extreme would know about 200. This is great. But the problem is, if you're wrong, or even if you're not wrong, but just some randomness happens, some black swan hits you, and one of your stock declines 50%, now your portfolio is down 25%. So when you are under diversified, the cost of being wrong is too high. As an investor, what I try to do, you try to find a medium that where every decision you do matters, but when the cost of being wrong is not too high, and this number is going to be different from one investor to another. This is 10, 15 years ago. I was at a conference, and I was talking to Monish Pabrai, and I think Monish had at the time like maybe 6 stocks or 10 stocks, I forget. And I asked him, how can you handle like such a concentration? And he says, don't look at me, look at this guy, and he only has 3 stocks. So it's going to be different from one person to another. And one other point, and this is very important, your diversification or concentration level, however you wanted to express it, should be function of, should fit to your personality. Mm-hmm. So if I own 200 stocks, it would drive me crazy because I would know nothing about them. And if I own 2 stocks, I would not be able to sleep at night.
Yeah.
So for us, we usually own 20 to 30 stocks, maybe 20, 25 stocks. Average position size, we aim for 5%. Mm-hmm. It's going to range from 3 to 7. And with this kind of concentration, I can sleep well at night.
When one of your companies grows to, let's say, 5, 10, 20%, at what point do you start rebalancing?
It's a good question. To some degree, it's usually happens when when the company appreciates a lot. It's relation to fair value, and it's depending on the company. This is going to be depending on the company. So it's almost like there are two questions in it. One is, what's your sell discipline? Let me answer the question that I'm going to ask myself. What is my sell discipline in this case? When I own a company, it's a slow growing company, I'm going to be a lot more aggressive with my selling. Mm-hmm. When I own a company that is a fast grower, I'm going to have a much longer sales leash. So like, I'll give you an example. I'm going to make up two companies. Actually, we own both. But let's say McKesson versus Twilio. Twilio is growing, I don't know, 30 to 50% a year.
Wait, you own Twilio?
Yes, I know. So you're going to lose respect from me after this.
No, I'm not. It's actually... I mean, I don't want to interrupt you, but I'm sorry, go on.
Well, so let me finish this, so we can go back to Twilio if you want. Mm-hmm. So Twilio is growing so fast that our sales leash on Twilio is much longer. So we would be trimming, when it got to be a very large part of our portfolio, I would sell 10, 20% of it like every few months because it kept going up. With McKesson, let's see, if it's worth $250, we would be probably sell one half around to 30, another half now to 70 or something. So it's a much shorter, more narrow range of selling. So that's basically most likely how we're going to control position size in this case. Yeah.
Back to Twilio.
Yes.
What attracted you in Twilio? And obviously it's not very value invest-ish stock based on traditional understanding of value investing by institutional investors, I'd say.
Yeah, so this is why I struggle with the whole thing. Like when I say value investing is in cheap stocks, cheap based on what? Like you can have a company that's a Melson Ice Cube that's trading at 10 times earnings, and that's overvalued. So a while back, I realized that we want to have a portfolio that's not just full of ice cubes, melting ice cubes.
Yeah.
Okay, so we did a couple of things for that. Number one, we said we want to own high quality. And if the company does not pass our quality test, we stop. So our analysis stops and we move on. Okay. Second thing we did, we wanted to introduce growth elements. So in other words, when I say growth, I mean companies that that are growing earnings and pay dividends. Mm-hmm. Sometimes it's both. Sometimes it's just one. Sometimes it's the other one. How do you deal with that? So we did an interesting trick. When we remember I told you how when we value companies, we look 4 to 5 years out. So we figure out what the company is worth 4 or 5 years out, and then figure out how much we want to pay for this company today. Mm-hmm. If you do this with a company that's not growing earnings, you need to have a much greater discount to its fair value for it to make it into our portfolio because time is not in your side. If you think about it, right? If company is worth $100 4 years from now and it's not growing, its value today is still going to be $100 as well, right? So the value doesn't change. So therefore, I need to have a much greater discount to its fair value for it to make it to our portfolio. Now, if I own a company that's growing earnings substantially, its value going to rise over time as well. And therefore, if I look 4 years out and I find the earnings have tripled, then the company is worth a lot more. So therefore, from that price, I discount it today, and that gives us a buy price. So the question becomes, how did Twilio make it into our portfolio? Because it really has no earnings yet. And the way we looked at it, when we bought it, and this was late, I forget, 2017, early 2018, the stock completely annihilated. And I figured out if their growth rate declines from 50% what it was growing then to 20, 3 years out, we'll be paying 2 times revenues. Mm. And on the 2 times revenues, that's basically most of software companies don't ever trade at less than 2 times revenues.
Oh, no, never, no.
So exactly. So that was kind of our margin of safety. But also one important element to me was that at the time when we looked at Twilio, we realized they're kind of the Google of smart communications. And what I also realized that they had a founder who really wanted the company to succeed. So you had that going for them. And the reason they were not profitable was because they were spending $150 million on R&D. So if you look at R&D and you say, well, if they cut R&D from $150 million to 20, okay, and the competitors were spending like $1 million or $2 million, okay, what would the earnings power be? So once you start looking at it this way and you start treating R&D as almost like capital expenditures, then you realize actually It wasn't that expensive. So, but you had to look at it from a very different perspective. So because it had margin of safety, I figured in the worst case, we're not going to make money. So it kind of, you can see how you can take a company like Twilio and still fits into our investment framework.
What's your investment process like? How do you find the stocks you're interested in, and what do you look at?
So it's a great question. So the stock discovery process is very random. It's not like I open Forbes magazine on page 15, that's where I find my ideas. That's not how it works, right? It's basically, you want to expose yourself to randomness. So you want to expose yourself to that that idea is going to come from very random places. And I probably spent maybe 6 months to a year looking at Twilio before I had an insight, that aha moment where I realized, oh, really, this is not really a communications company. This is really a software company. Once I started looking at it that way, this is when the light went on. So, but basically we do screens, we talk to other value investors, and I have a significant network of other like-minded value investors I talk to all the time. I'm a member of Value Investor Club, so I get ideas there. We read a lot. So ideas come from very random places, but once idea comes to us, we say, okay, well, is it a quality business? Do we understand it, what it's worth? Do we have this little insight, something that gave me different perspective from everybody else? Long time ago, we used to own Apple. And I think we bought it, I forget, 2012 or something. And the time it was like one of the most hated stocks on Wall Street. And my variant perception was that on Apple, that it's not a hardware company. It's more of a software company. Once you buy an iPhone, 9 out of 10 people are not going to switch to Android. And that means every 2 or 3 years, you're going to buy another iPhone.
Mm-hmm, yeah.
So there is a built-in recurrence of revenues. And once you have that insight, it's a lot easier to buy Apple when everybody hates it. So you look for this insight. I cannot tell you how many companies I look at. I have no insight and I just move on.
What did you learn from your biggest winners and from your biggest losers? And do you remember them very well?
Yes. Actually, it's kind of interesting. You were there when, my biggest loser actually is not the company that I lost money on, it's the company I did not make as much money on. And you were there. So
Electronic Arts? Electronic Arts?
Yes. Yeah, Electronic. So I don't know if you...
still blown away. Yeah, I remember. I actually going to tell the story.
Well, go ahead.
Back, and I think it was 2012, yeah. So we hosted a Value Investing seminar at San Francisco State University, and you were one of the 5 speakers. And what's amazing to me, with value investors, is very humble group of people in general. You're all very successful, yet I reached out to you, and you didn't know who I was, at least, right? And you just flew to San Francisco, and you spoke about your favorite stock to students who you've never met. And that was Electronic Arts. And I don't remember how many X's were your returns, but I do remember looking back and thinking, holy cow, I wish I listened to Vitaliy and bought this stock. What was the return on that? Do you remember?
Well, yeah, very vividly. And so this is where the failures come in. So when somebody asks you this question, what's your biggest failures? You usually think about the company you bought and the stock decline you lost money on, right? But in the worst case, you can only lose 100%. Mm-hmm. This one, I lost a lot more. And here's why. Mm-hmm. So we bought Electronic Arts at, I think, $16. It declined to 13. And when I was at that conference, if you look at the stock price, I think it was 10 or 11. And so just realize at that time, I was already down 40% of the stock. And, and every single news, I remember the presentation vividly because every single news that came out about Electronic Arts, it was actually for 2 years in a row, there's some kind of magazine, the company was listed as the worst company of the year. And the year, 2 years before that, BP was and the year before that was I don't know, Philip Morris or something. So this a consumerist magazine. And so it was a really hated stock. And my insight at the time was that basically there was a transition from packaged software to download software. And when this transition happens, the revenues don't show that, but the margins do. And once this transition happens, the margins will skyrocket. Plus, cell phones and etc. It's a basic gaming device in our pockets, right? And anyway, long story short, so the owning electronic cards for a year was a very painful experience because like we lost money, from $16 to 10, which is, and we bought more and still lost money. And what happens during to you at this time is that this self-doubt starts to kick in. So I remember vividly when I was doing a presentation, how painful it was for me to make this presentation because I knew that my analysis was right, but it was still so painful because we were losing money on the stock. And then the stock doubles, I celebrate, and I sell. So we double the money. Except then it goes and doubles 2 more times, so it's quadruples. So when you ask me about my mistakes, we made $15, and I may have left another $90 on the table, basically.
90?
Well, because it went to 120.
Oh my God.
So
I knew it's a multi-bagger. I didn't realize that it made more than 10x. Oh.
So let me tell you what I learned from this. When you are losing money, time slows down. And every day of losses becomes torturous. So what I learned is that, and so if you zoom in and you look at the stocks on a daily basis and you let this kind of daily losses to get to you, I was just happy to make money on the stock and to get out because that experience of owning for a year and not making money got to me. Mm-hmm. Okay, so now when this happens to me, I try to zoom out. So the mistake, so the reason we made the mistake because it was a mistake. It was it's not that the stock went up because it went up for the right reasons. It went up for all the reasons I described when we bought it, and we sold it too soon. If I looked at the next 3 to 4 years out, but I was just exhausted from owning it. Mm-hmm. So now when when I have a company and does what electronic cards does, which happens quite often, I zoom out. Like if I still analyze the company, but I try to mentally zoom out, kind of look at it from a much larger perspective and say, okay, well, 3 to 5 years out, what is the value? So that was one of the most important lessons for me.
You've been in the investment management industry for some time. How do you see it's changing?
So it's kind of interesting. It's getting dumber and smarter at the same time. Every time somebody buys a index fund, the IQ of the my industry declines. Right? Because by definition, index funds are dumb, right? It's not when you buy an index fund, you say, I just want to buy everything. Yeah. Okay. So on one side, it's getting dumber, and at some point, active investors are struggling because of that. But at some point, it's going to revert, and money is going to come back to active investors because right now, when the market is going up, there's self-fulfilling mechanism in the index funds construction that basically benefits companies with larger market caps. At the same time, I think we're going to go through a transition where value investing that's done by recipe mindlessly, I'm buying stocks that trade at 10 times earnings or less, it's going to be incredibly difficult to make money in doing that kind of value investing. Yeah, I'm working on this book, which is called The Intellectual Investor. And when I say I'm working on this, I'm writing it for me. So my first book, Active Value Investing, I wrote it for my competitors. Basically, it's 250 pages, 75 charts and tables, a lot of words, big words. The second book, which basically the little book of Sideways Markets, was my first book, kind of simplified and written for your neighborhood dentist, somebody who is smart, educated, but is not an investment expert. So, but this book, I'm literally writing for me. The purpose of the book is to make me more creative and to make me a better investor. So when the time comes and I start competing with algorithms, kind of AI, I'll be prepared for that. So that is kind of the purpose of the book. And since I'm writing for myself, there is kind of no deadline. I'm done when I'm done.
Do you intend to sell it at all? Because you're saying
no. I'll sell it, but let me explain what it means. So when you write a book, there is a deadline. When I wrote my books, there was a deadline, and I had to get it done by those deadlines. This one, I'm really writing for my enjoyment and for my exploratory kind of journey. It's kind of interesting. Focus is not always a good thing, or deadlines not always a good thing, because what happens if I had a deadline? I said, I had to get the book done by January 31st, 2021, then I would be focused to get it done. And what would happen, I would miss out on things. I would be looking only straight. I would not be looking left or right. and we would be missing out on things. So this is why me not having a deadline allows me to be more mindful and more creative and looking at things that I wouldn't look otherwise. So that's why I kind of refuse to set a deadline for myself. Mm-hmm. I think at some point my wife will get sick of me working on this book and say, just get it done. But, we're not there yet. So,
how do you manage time between investing, writing, and family? Because investing on its own, it's a very competitive game. You compete against some of the smartest people in the world, probably, right? Yet you find time to do something else.
A couple things. So I get up at 5 o'clock in the morning, and from 5 to 7 o'clock or so, I write. So if you think about it, I'm probably write about 14, 15 hours a week just by doing that, which is probably, if you do it over it's probably 700 hours a year. Mm-hmm. That's, most people spend a small fraction of that writing. Then I come to the office and I work from 8 to 4, and then I go home and spend time with kids. And then I also read a lot. What I learned is that not about how many hours you work, but it's how productive you are with working. Mm-hmm. I'm struggling with this just like everybody else does. But I try extremely hard to kind of create this oasis where I can work and try to block out distractions. I don't look at our portfolio like more than once a day. And this is not because I'm indifferent what happens to my stocks. It's just because if you look at it on a continuous basis, all it does, you just look, first of all, you're seeing, even I probably should not have been looking at it once a day, but all you're seeing is just randomness and just distracts you from what you should be doing. Also, my oldest son is 18. My two daughters are 13 and 5. And I'm extremely conscious that I really want to spend, they won't be young for long. My son is going away to Israel this Sunday. And that actually, I cannot tell you how much it hurts. Oh. It's not, I'm not concerned about him going to Israel. I'm not concerned about him. I'm concerned about me. I'm concerned about me because I'm going to miss him so much. But that makes me appreciate my younger kids even more. So I tried very hard when I'm at home to be present. I'm just like everybody else, work in progress. But I'm aware of that at least. And I read somewhere that attention is the currency of time. So I can be at home, and if I am just, if I'm just sitting at the dinner table and I'm looking at my phone, am I really there? Physically, I'm there, but if I give attention to my kids, then I'm there with them. And then I try to read as much as possible and try to read in diverse subjects. And in all fairness, for me, this is not a job, but this is kind of a hobby in the sense that if tomorrow I didn't have to work for a living, I would still be doing the same thing. So it's in a sense, I'm doing because of out of love, not because I have to.
No, one thing I wanted to ask you about, you've been in the industry for a long time. You've been investing for a long time. You've written the books on investing and building wealth pretty much. And there is the whole industry that are full of people who I believe are not really qualified to give this financial advice. What would you recommend to young people who are not value investors themselves and not in investment business in general? How would you recommend them to build their wealth, let's say?
It's funny you say this, and I don't mean to be self-promotional, but this week I just wrote an article that comes out on this subject. I wrote this article for my son, and I don't write articles on personal finance because in general, personal finance kind of bores me. Or taxes bore me, etc. So I'm just kind of stocks are us kind of guy. So I'm really passionate about investing. But when my wife and I got married, a friend of mine, Mark Bauer, sat down with me. That was his gift to me and my wife. He took us out to lunch and said, "Here's my advice to you: create a budget." And I was a little bit offended because at that point I was, I had a master's degree, I had a CFA. And he said, you don't just put on this, so you have your revenue, you have your income, you have your expenses, how much you spend on food, on groceries, on the rent, etc. But what I would like you to put there is think of the future expenses you're going to have. The expenses that happen kind of in lumpy, like sometimes some of those expenses will happen in the future, far away. Some of them happen every 5 years, but we just don't think about them. So guess what? Most of us buy a car every 5 or 10 years. So you may not need to buy a car today, but 5 years from now, you're going to need a car. don't let it to become a surprise for you, because when it becomes a surprise, it means you borrow money to buy it.
Mm-hmm.
So he taught me a concept of sinking funds. So we literally, my wife and I, after the sit down, we created a budget. We thought of all different expenses. Like, I'll give an example, like we wanted to buy a new TV. So we put a TV in the sinking fund. We realized that at some point we're going to have emergencies. We're going to have an emergency fund. So we basically created a budget that had sinking funds. And therefore, the amount of money was left over was a lot less than we thought. So my wife and I never we had plenty of other disagreements, believe me, but we never had disagreements about money because we were kind of on the same page with that. One thing I learned is that how much money you make has very little to do with how much money you have saved. It's all about your expenses, right? And so I encourage your listeners to read my article because it goes into depth about that topic. But the point is this. So it's not just about making money. It's also how you spend money. And I think budgeting is very important. Okay. And one thing budgeting does, it helps you prioritize what matters. Mm-hmm. One thing I learned that in life, we do things by default. Like we do things because we do things. We just don't think about it. It happens automatically. It's kind of a default settings. And then you discover it in the hindsight, maybe I shouldn't have been doing that. I'll give you an example. You may value travel a lot more than you value having a new car. But time comes to buy a new car and you spend hundreds, I don't know, $50,000 or $60,000, whatever, on the car. And then what had just happened is that the monthly payment, for the car, it just took away money from your travel budget.
Okay, I see.
So what happens is that now you can't travel as much as you'd like, or if you do, now you're basically going in debt. And so therefore you made a mindless decision because you didn't think about it. So budget helps to prioritize what matters to you. And therefore, when the time comes to buy a car, you say, well, you know what? Yeah, maybe I'll buy a used car. And the money I save, that allows me to have an extra vacation a year, as an example. So anyway, but that's not what you're asking me. So that really comes down to savings. About investing, I would, if somebody wants to learn investing, I would take as much money as you can afford to lose, and I would start investing like in very few stocks. Because when you invest in this, especially if you're in the beginning, you're going to make mistakes and you're going to make very painful mistakes. So you may lose money. But also when you make these investment decisions, it's very difficult for somebody who's starting out to build a portfolio, because to build a portfolio now you have talking about, I don't know, 20 stocks or so. Mm-hmm. And it's very difficult for somebody to follow this many stocks at once. So when you buy those few stocks, all you're trying to do is to learn how to analyze companies. And more importantly, you learn about your emotions, because investing is a lot more than just analysis. It's about dealing with your emotions. I gave you that example with electronic cards, right?
Yeah.
To me, that was a lesson, not an analytical lesson. That was a lesson of how I should deal with my own emotions and how I should zoom out. It has nothing to do with kind of analysis itself. Okay. So anyway, I would look at it as your tuition and just, take a few $1,000s and start investing little by little. And if you lose that money, think about it as, you just took a few classes at your overpriced university. That's how I would do it.
Vitaliy, you immigrated to the United States from Soviet Union.
That's right.
Looking back on your childhood, was there anything that would show that you would become an investor in the future?
It's a good question. So when I was in Russia, I went to Marine College, which is a technical semi-military school. So I was a cadet. Yep. I wore a uniform. You know the story, right? Yep. Let's see. I wore a uniform. I had a commanded officer. I had lived in barracks. And basically, I subjugated myself to that because I didn't want to join Russian army. At the time, parents did not want their sons to go to Russian army because it was not like going to 2 or 3 year prison. I understand that this is not the case in Russia today. So, but at the time, that's what it was.
Yeah.
So nobody wanted to join Russian army. And so I was in this school and I was studying mechanical engineering, and I absolutely hated every single class I took because I wasn't really there because I wanted to be there. Because I had to be there. I think the only class that I did well was economics. So that would have been probably the first hint that I may have, like that's a class where I just aced it without any kind of effort. It was like something that came incredibly natural to me, which is physics didn't or biology didn't. When I thought of investing, I remember vividly when I think I saw Trading Places, and I saw that. Remember the scene where they trade orange futures or whatever in the Trading Places. I thought that's what investing was. People throwing papers up and trying to buy stuff in this kind of chaotic place.
Very stereotypical Wall Street, basically.
Exactly. So when I was in Russia, I guess I did not know what investing what really was, and so I remember I grew up in a Soviet era, like where private businesses did not exist for the most part. So I knew nothing about investing. So when I left Russia, I did not think that I would become an investor. Me becoming an investor was a completely accidental experience. I was very good with computers. And the reason I was good with computers is because when I moved to the United States, my parents bought me a computer and I was playing with that. And at the time, I was like, some people collected like CDs, books. I was collecting software programs. I have no idea why, but I remember a friend of mine and I were trading. I gave him a floppy disk of this software, and he gave me a floppy disk of that software. I have no idea why I even needed that. But anyway, I did not been good. And this is early 90s, been very good with computers. I knew how to, and this is before Windows. So this was, still, we had DOS. So I knew kind of DOS operating system fairly well, which at the time was, believe it or not, was a skill.
Yeah.
So I got a job at the investment firm helping with computers. What was interesting, so now we already have Windows at the time. They needed to write a database in Microsoft Access. And I knew nothing about Microsoft Access, but at the time, Microsoft had a free technical support, unlimited technical support. So I remember spending like 5 hours at a time as a Microsoft engineer, and he basically teaching me how to use Access. But when I was there, in addition to learning Microsoft Access, I learned how, they had a Bloomberg terminal. I started playing with Bloomberg, and I really liked it. So I changed my major to finance, and that's how I got into investing.
And you started at Investment Management Associate right after?
Actually, I started a different firm, but they did not need an analyst. So I ended up leaving, for IMA,
So you started as an analyst, though, and you became CEO.
Yes.
Give advice to young kids how to get from analyst to the top position.
I'm not sure I have an advice. I fall in love. I mean, I fell in love. Basically, I love what I'm doing. So because when you love what you do, you're going to spend more time on the subject than somebody else who doesn't.
So you outwork everyone because you really liked what you do when everybody else probably wanted to go home.
That's right. Yeah. So this is one of those professions where if you do it for money, you get outcompeted by people who do it for passion.
Oh, I see.
Love.
That's
okay. So if you just doing it for money, then it's the wrong profession to be in, because you be competing against people who, like Warren Buffett, who only he doesn't care about money.
Yeah.
For him it's a puzzle.
So what I have now, Vitaliy, is like quick blitz. I'll ask you a quick question and you'll give me a quick answer. How does it sound?
We can try. I mean, giving quick answers is not something I'm usually, but we can try.
So what's your favorite movie?
Get Shorty.
Favorite movie star? Danny DeVito, I guess.
Danny DeVito would be one. Yeah, he's at the top of the list. Yes, absolutely.
Your favorite singer or a band?
Queen.
Queen. Oh, here you go. Your favorite book?
Nonfiction would be probably Fooled by Randomness or Subtle Art of Not Giving a Fuck. So that's
I saw you were talking about this book very.
I apologize for the title, but I didn't write it. So I
saw your very detailed review of the book, and it's actually very interesting. I agree.
It had a huge impact on me. I think it's one of those books that I would highly recommend to anybody. Just ignore the title, get over it, and read the book, and you'll see that title kind of cheapens the book a little bit.
Yeah, I see. What's your favorite thing to do?
Outside of investing, probably spend time with kids, listen to classical music.
What's your favorite place in the U.S.?
Denver would be number one.
Mm-hmm.
Southern California, probably number 2. Sorry, to Northern California.
Yeah, I'm like, oh God, I feel bad. Okay. What's your favorite country to visit?
I understand Europe is not a country, but in general,
Yeah.
I love Europe. I learned this year that I love Switzerland. Almost, pick any Western European country, Switzerland, Italy, I love them all.
Who's your favorite historical figure?
Nelson Mandela. I visited South Africa twice, and every single time I'm blown away by what he has done. What he has done was so selfless. After spending, 29 years in jail, in prison, he comes out and there's absolutely zero resentment, and he unites the country. When you think about historical figures, you think of them usually, it's very few people can transform in a country in a positive way.
Yeah.
A lot of them can do it in a negative way, right? Look at what happened in Zimbabwe. Look at what happened to Germany. Look at what happened to Soviet Union under Stalin. So it's very easy to do. It's very easy for historical figures to transform a country in a negative way.
Yeah.
But Nelson Mandela, to me, what he has done is absolutely phenomenal. So hands down, Nelson Mandela.
Got it. What's the first item on your bucket list?
I don't have a bucket list. I just live.
It was a very quick answer. Nice.
Yeah.
Do you have a favorite quote?
Yes, this one applies to investing a lot, but I'm sure they have other ones. And this one is misattributed to Yogi Berra, but it's actually somebody else said it. In theory, there is no difference between theory and practice. In practice, there is.
Yeah,
and I think some mathematician said it, and I forget his name. But I'm sure I have other ones. But this is the one that comes to mind. Quick.
Yeah. And the last question, what life advice would you give to young people today?
Career advice, I would say, do what you love, because life is too short. And life advice is be kind. A lot of times we focus on being right. And a lot of times in the quest of being right, we forget to be kind. And, we often destroy a person through that. I stop myself often in conversations where I feel like if I go further, I'm going to hurt the person. So I try to be kind and, not being right.
Got it. Well, Vitaliy, thank you very much for the advice, and thank you very much for the podcast.
It's my pleasure. And I love that, that the name of the podcast is The Accent. Now your listeners get 2 for the price of 1.
Thank you for listening to The Accent Podcast. For more episodes, please visit theaccentpodcast.com. Until next time.